Thank you. My name is Jean Raby. I'm a partner at Astorg. I had a long storied career from law to banking to asset management when I ran an asset management firm called Natixis Investment Managers for 4 years, a multi-boutique, 1 trillion euros of assets under management, and now in private equity. So I no doubt my questions or commentary on what we're going to be discussing are going to be influenced by this perspective. Now, I'm very happy to be joined by Xavier Meyer, CEO of Aberdeen, and Joseph Pinto, with whom I had actually worked at NIM, but this is not how we came about on this panel, who's now CEO of M&G Asset Management. I would propose that first, each of them introduce themselves with, and specifically what their firm does. And I'd like to kick off the conversation by a simple question. And we just saw that in the video, people thinking 3 to 5 years down the road, you know, managing the I don't know, prévoir l'imprévisible or the theme of this conference. Perhaps comment on what they see as the single biggest strategic objective they have by 2030 in both of their respective businesses. And we'll start the debate from that. And then, no doubt, talk about the topics that have been highlighted in the summary of the conference, notably technology and scale and specialization. But first, Xavier, over to you.
Thank you, Jean. Bonjour à tous. I'm Xavier Meyer. I'm the CEO of Aberdeen Investments. So Aberdeen as a group manage currently a little bit more than 600 billion euro of assets under management, of which 70% is managed under the asset manager of Aberdeen. If I focus on the asset management, roughly 80% of our assets come from institutional clients. We have an on-the-ground presence in 23 countries, and we are defining ourselves as a specialist asset manager, because with 600 billion of assets under management, we are definitely a very large UK player, but we are probably a large mid-sized player on a global scale. When I think about asset management, it's an industry that is going through a lot of changes. The individual wealth is expected to grow slightly faster than institutional assets on a go-forward basis, primarily because of the demographic transition and the fact that more and more individuals are going to self-fund their retirement. The demand for private market, we just heard that about just now, keep growing at probably double-digit per annum on a go-forward basis. All that reflecting both the easiness to invest in these assets now with the disintermediation from traditional banking channel, as well as the structural needs to invest in artificial intelligence, in infrastructure, and in the reindustrialization of the West. So back to your questions, when I think about what is my single largest challenge or opportunity on a go-forward basis, is to make sure that Aberdeen is fit for purpose for the future. Which means keep being a specialist in our area of specialties, in fixed income, in specialized equity, in real assets, harvest technological benefits in order to improve our performance and our client experience, and keep the business model efficient and resilient. In particular, as we're probably going to go towards 50% plus of our profit coming from private market, and a significantly larger share of our assets under management coming from individual wealth.
Joseph.
Happy to be here. Joseph Pinto, CEO of M&G Investment. Like for Xavier, we are French based in London. Happy to have the conference in English, by the way.
Could have been in Quebec or in Quebecois.
Yes, absolutely. So M&G has been created again in 2019. Historically, M&G belonged to Prudential Insurance Group. Prudential decided to focus their activities in Asia, and now M&G has 2 big activities: life insurance business and asset management. I'm the CEO of the asset management business. I think that's a particularity that is quite important in the way we want to grow the asset management business. We are very strong in public markets for sure, but also in private markets. And if I look at the growth story of the company moving forward, it will be on private markets. Out of the 400 billion, roughly, euros of assets we manage, we are about at 90 billion coming from private market, the rest from fixed income, equities, multi-assets. We've been very strong in delivering strong performance to clients on public markets, equities in particular, but also fixed income. And the push into private markets has been heavily supported by the access to permanent capital, which is capital provided by the life insurance company in the UK. We are, in effect, Prudential in the UK, even we don't use that brand anymore somehow, because now Prudential is in Asia. We have close to 5 million customers, and our objective is to help the 5 million clients in the UK to have a great outcome by having the best of M&G products out there. So strategically, the push on private market, especially private market for wealth clients, it's the key opportunity that we see for the industry and for M&G as well between now and 2030. So that's, in a nutshell, what we do in terms of asset classes in private market. We are very strong in private credit and real estate, and we have some activities in private equity, mostly fund of fund and infrastructure. Effectively, as Xavier mentioned, the key trends of the industries are the one that we see, why we see demand, and where we see effectively how we can finance the economy even better, especially in the private credit space, as we are a strong direct lender in Europe, but also in Asia. Geographically, and I would close there, we were born in the UK. We are now a very strong continental European player on top of the UK. And we've been doing, over the past, let's say, 6-7 years, a massive push in Asia. We heavily invested there, and all the growth on top of private market should come from Asian clients as well. We have a little bit of activity in the US, but we cannot be everywhere. We want to compete in the areas where we believe we have a chance to win, which are the ones that I've just mentioned.
Thank you. Well, I see many themes from from those introductory comments, from specialization to the rise of private wealth. I'd like first to start with something neither of you mentioned. Frankly, we would be in any other industry grouping. I think we've been talking 8 minutes, the word AI would have popped up. The word technology would have popped up. It did not. Why is that? Are you not investing in data scientists, in use cases? I'll make it a constructed question, but I'm just a bit surprised. None of you mentioned it. How are you thinking about AI and technology in your operations, in the way you invest, in the way you distribute? And is this a critical factor of success by 2030? And I'll ask both of you to comment on that. And perhaps since I started with Xavier, Joseph, over to you.
We do AI, and to reassure you, Jean, I did expect the question to come on AI. It is on the how, to some extent, and AI is everywhere in what we do. Needless to tell you, as we are a listed firm, the key KPI that investors, analysts look at when they look at the asset management business is cost-income ratio. We live in an industry where there is pressure on fees. I'm sure you are familiar with that as well. And we need to deliver the same outcome in the future, even a better outcome to clients at a lower fee. That's the trend that has characterized asset management over the past 20 years, and it's here to stay. Now, for sure, we need to make sure that we have value for money. That's what clients want. And us, as provider of solutions to clients, make sure that we are fairly paid, ultimately. So it means that we have to embrace technology in everything of what we do. As you said, so we do have plenty of data scientists around the company. We use AI, and we've equipped all our employees with Copilot, by the way, to make sure that they can increase their own efficiency and use all the available information that is out there within the company, but also outside, in a very secured way. And when it comes into specific cases where we've been well advanced on AI, as we are a strong provider of private market solutions, but also public fixed income, our first pilot was 2.5 years ago in the research space. So we did plug a team of data scientists using AI with the research team, basically to have augmented research. And cover more names that we've been able to do with the size of the research team we have, which is already a substantial one, and being able to deliver better value for the portfolio managers. We've been extending that from public fixed income to private credit progressively, adding a number of AI experts. On top of it, in the equity space, actually even before we've been talking about AI, I think five to 6 years ago, we launched a global equity quant strategy using AI as the core of the investment process. It's probably 75–80% machine driven, and then 20% human overlay. You always need a human overlay when you use AI to make sure that what you deliver to clients makes sense ultimately.
Do you think you have delivered better performance?
We've delivered good performance to clients. It's a global income strategy, size about $1 billion. We've had successes in few geographies, and now we've decided to package the same strategy into an active ETF to access basically digital savvy clients who wants to basically buy online and love to have those ETFs delivered to them, not in the way you, maybe Jean or me, used to buy funds through intermediaries. They want to buy it direct. They want to have it digitally distributed. They want to have the best reporting out there using technology. And that's why we've decided to package it that way. So that's what we've been doing in AI and technology. Last but not least, I mentioned the cost-income ratio. For sure, wherever we can bring cost efficiency, we will. Not necessarily to cut cost, but essentially to grow the business, meaning the revenues, and making sure the costs don't follow the same curve of the one of the revenues, and create the leverage we need to improve the profitability.
So more at constant headcount.
Eventually. So a current test we have right now is the RFP team. So we keep answering RFPs to clients. So we have a sizable team out there. And we've just made a calculation on how efficient that team can be by using AI. And frankly, we can multiply by two, double the number of RFPs the team can answer with the same capacity, the same number of people, and also reduce the time by more than half to answer to clients. I can tell you that coming from Europe, UK, moving into Asia, I don't know if there are Asians in the room, when they ask you a question, they expect you to answer really in a speedy manner. I think we are not used to it necessarily in Europe, but they want to move so fast, they want to make decisions far more quickly than what we are used culturally in Europe, which forced us to use basically technology and AI to answer those needs. So it is bringing more business for us and also controlling the cost in a better way than we've been able to do in the past.
Xavier, not necessarily rebutting, but perhaps your perspective on technology and the importance it underpins your strategic objectives.
There's obviously a lot of similarities between what Joseph is doing with its organization and what we are seeing as well. It is a very important and critical technology, and it got to get even more important going forward. When I think about AI and our experience of using AI within Aberdeen, there are basically two dimensions. There's an horizontal use of AI across all divisions that is very much for productivity gain. And we are probably at the middle of this journey. And as of today, we probably estimate that we gain 20 minutes a day because of the use of Gen AI. Which, when you put it differently, it's 4% productivity gain. It's not negligible, but one may say that it's just the catch-up of the supposed productivity gain that we should have had over the past few years. But if you keep that productivity analogy, and you use that to assess actually whether is there a bubble on AI stocks. Actually, if you believe that across the entire industry, and not asset management industry, but the sum of all our industries, Gen AI and the current wave of AI and computing power can help us gain a low-teen increase of productivity. Well, actually, when you correct the valuation of the tech stocks, you will end up with the valuation of the rest of the US market. So put it differently, if you believe that you can get a 10 to 12 to 15% productivity gain over the long term with AI, we are just at the beginning of the formation of the bubble. So that is the horizontal one. The vertical one, as Joseph alluded, which is more interesting, is less about productivity across the board, but how do you change and transform your investment processes? And we have done a few things, actually even before Gen AI. It has been a few years that we have been running, for example, AI to help us go through the central bank speeches, the policy minutes, and try to extract whether the comments are hawkish or dovish, and put that into an index that basically help us having predictive power over the evolution of government yield. And it has been quite actually accurate. Now we are starting to see with Gen AI a new generation of this use case where artificial intelligence has been used, and we have done a number of experiments in asset management industry for years. One of the problems we had is that we were not necessarily able to reverse engineer the result coming from the machine. And what Gen AI does, when you put a Gen AI on top of a more traditional AI model, is to question that model. To ask, okay, I see that your result makes sense. Where does it come from? And I think that's a very interesting and an innovative way to use AI that will basically help us in generating more educated investment decision.
So you think that technology makes you or will make you a better investor? Because you talked a lot about productivity gains.
Yes,
you didn't talk a lot
let's
about performance gains. Maybe, Joseph.
Yeah, let's go back to that point. There's one thing I'd like to add, actually, because as you rightly said, and it was mentioned by Dominique Sénéquier before, yes, there could be a bubble in AI, but in the long term, AI is here to stay, and it will transform the world, not only our industry, of the three of us or whoever is in the room, but all the sectors worldwide. So I'd like to come back to a point on AI. Every research analyst that we have covering equity stocks or any portfolio manager buying equities or private market, real estate, private credit, or even public fixed income, all of them have to understand what AI does to the sectors they cover. Not only you have effectively the AI producers in the world, the famous tech companies in the US or elsewhere, but you have all the benefactors. I don't know a sector that is not affected by AI today. And us, as investors, we need to understand when we buy a stock, when we buy a bond of a company, how they are affected by AI. How are they going to change themselves, their prospect, profits, or productivity? That's why AI will be everywhere. If you were to speak to the famous analysts of the industry, everywhere, they will tell you that they used to cover a sector, whatever the sector, and today they spend more than 40% trying to understand how AI will transform their sector. Because that will tell them who will the winners and losers be in their given sector. The winners of the past may become the losers of tomorrow if they don't embrace AI the right way. This is why it percolates everywhere in our company, as at the end, we're here to deliver performance for the clients.
Do you put the investment committee memo in your private asset business? Do you put the investment committee memo, the consultant reports, the due diligence interviews in the AI model and have the AI voice be heard at the investment committee, for instance?
Not at this stage.
Not yet, or not?
Not for the time being. While we use AI, humans still are the ones who vote. What about you, Jean? Do you do it at Astorg?
No, but we're asking ourselves the questions like others do. Do we make AI a voice at the IC?
Do you believe it's mature enough today?
I'm not on the panel. Xavier, what do you think of these?
I think it's an interesting one, and I wouldn't be surprised that it becomes like that over the long term. What we are starting to do a bit about AI is implement it more and more as an additional source of input. And actually, over time, we're going to track how this additional source of input is actually accurate. Because if it tends to be more accurate than the judgment done by the investment teams, then this is where you have probably to intervene to make sure that actually there's a little bit more integration in the process. So we are not yet there, but I could foresee a future over the very long run where it would be a voice among others. I think the previous panel, there was a point that resonated a lot with me, is ultimately the phase that you have in the leadership of the companies you invest in. And that's probably something where, as a human, we still have a hedge in assessing.
I tend to concur with that. That's why we still, in the public capital markets, to still do roadshows to meet management teams and have develop a view on the management capabilities. Now, we talk a lot about technology already, and we're nearly half of the panel. I'd like to come back to something you said, Xavier, which struck me. Aberdeen, 600 billion pounds, presumably? Euros, sorry. Still a lot. And you're a specialist across asset classes, fixed income, real assets, specialized equities. Astorg, we have 24 billion. We only do mid-market, pan-European buyout, and we consider ourselves, given we're focused on 3 verticals, multi-specialist. And you, at 600 billion, like 25 times our size, you consider yourself a specialist. How's that possible?
Well, I think we have to look at the fact that we operate in an industry that is highly commoditized, with a number of our peers that are actually giant firms, in particular coming from the other side of the Atlantic. And when you have companies operating trillions or dozens of trillions, obviously at $500 billion, you're basically mid-size, upper part of the mid-size, large in the UK, but mid-size. And more than just like a statement, it's a mindset. And I think it's something that I profoundly wanted to imprint on the organization when I took over, is this view that we can't be good at everything. And we need to know where we genuinely add value to our clients, in particular as primarily an active asset manager. And obviously the range is, the assets are sizable, so it doesn't mean that we have only one specialization. We are specialized globally on fixed income, in emerging market and small cap, and on European real estate and global infrastructure. So it's relatively large, but it's still concentrated enough to have the right level of capital intensity in this field, the right level of expertise, and the right level of brain that we can have within the organization to generate performance for our clients.
Joseph, you have a view?
I've been in the industry for...
Because you didn't use those buzz terms. You didn't say we're large. We didn't say specialist. You were factual. You were fact-based. You didn't wrap it up in a mnemonic.
And I said we were balanced between access to capital from the insurance company, indeed. I think I've been in the industry for 30 years now. I think the industry has completely transformed itself, if you think about what happened over the past 3 decades. And I think a lot will happen even over the next 10 years. There will be more and more polarization. We used to talk about alpha forever, or active management, since I've been in the industry, even before. And it is true that clients now want to have access to true alpha. So I suspect what Xavier is mentioning is what you are doing as well at Astorg, what we are doing at M&G. There are 2 kinds of players, potentially, in my view, tomorrow that will survive in our industry. And we can talk about, I suspect, consolidation, M&A, all of it. The big players, because of size, can develop their business at scale, where the name of the game will be lower fees, scale, lower cost of production of unit, therefore profitable enough to basically deliver value to their shareholder and have their clients happy. In our case, our game is to be developing superior investment performance to clients, and that's the name of the game. Now, for sure, we cannot have the size of the first category of clients. And I think there will be more and more a polarization of that in our industry. You have plenty of players stuck somewhere in the middle. Today, they have access to captive clients. They are okay on performance. They've been protected, maybe because their market also was protected in their respective country. But in the future, they will be attacked either on the right or on the left by the 2 categories that I've mentioned. So on our side, every asset class we want to manage, a bit like both of you, we want to have the right to win. And if we believe we have the right to win, we double down, we invest, and we try to be as strong as we can be in those categories. In private market, I mentioned real estate. We're extremely strong in Europe, in core plus, or in Asia, also core plus, and value add. What we did in the real estate space, we bought a firm last year that does value add in real estate, because indeed, it's instead of just developing it from scratch, we bought competences from outside to reinforce the capabilities that are required by the clients. That's the philosophy of us, and that's why we've been in business for more than 100 years, and we believe we have a lot ahead of us.
Xavier, you wanted to add or complement?
Yeah, just compliment, because there's a lot of things that Joseph said that resonates with me, and I think we are seeing the same the same end game here. I think what is important also for an independent asset manager is when you choose your specialization, is to make sure also that they resonate with the long-term game. So, for example, I did mention that one of the areas that we want to push very hard is infrastructure. And the reason behind that is that we are largely underestimating the amount of investment that we need to generate in and bring to the infrastructure sector just to keep the lights on. Our research points out that in the next 25 years, we need 64 trillion of US dollar of investment to sustain the level of infrastructure that we know today. Big numbers are always difficult to apprehend. So it's 1.7% of GDP spent every single year, on top of investment in defense, on top of all the changes. So while some states may be able to fund that through public spending, the role of private funding is absolutely critical in that part of the business. So it's a specialization, but that has actually a long way to run.
I'll pause there on my initial question in this regard. I'd like to go back to a theme that both of you mentioned in your opening remarks that is everywhere in the press over the past 6 to 12 months, which is the rise of private wealth. And I'd like to hear your perspective on this, taking a broader view. Markets are very favorable nowadays. Private assets have gone through a period of sustainable outperformance when you look at over the long term. What are the pitfalls or the issues you're focused on as you map out your strategy in wealth? And a derivative of that is, don't you think your traditional investor constituencies, your third-party institutions that have sustained the industry on the private side, don't you think they may fear to be crowded out? And could a distinctive strategy be not to be tackling that source of growth? Who wants to take that first?
I can give it a try. I think you opened two doors. One was actually private market cross wealth, and the other one was more generally about the actors in that industry. So I'm going to try to address.
I agree. A bit of mixed bag of considerations.
That's fine. Well, fundamentally, the growth that is very significant. What I mean by very significant is that projections is that the Evergreen Fund for Wealth are probably supposed to grow at 33% of CAGR for the coming years. So it's a very significant growth. Fundamentally, this is a good news. It's a good news because this democratization of investment in private assets is allowing people to harvest the illiquidity premium. And here comes the risk. There is an illiquidity premium. And the management of liquidity is going to be absolutely crucial to the smooth evolution of this industry. And we are at the beginning of the wave. We have not necessarily been tested as an industry on a liquidity squeeze, but that will happen. And I think we have a collective responsibility, especially if you think that the benefits of this form of vehicle is for pensioners to grow faster their long-term savings than in traditional public markets. But you need to do that with liquidity at the heart of your mindset. And the irony is that actually, as an industry, we cracked the magic formula 150 years ago through investment trust, which is not a category that is popular out of US and the UK, but it's basically a close-ended that is listed with a secondary trading, which has been popular back in the days, but is actually a very old but very tested and relevant form of investment to allow individuals to invest in private markets.
Before I let Joseph compliment, I'll share a bit of an anecdote. I was at an industry gathering earlier this year, all representatives of essentially private equity firms around the world. And the subject of evergreen semi-liquid came up. And one person with visibly the expressing a consensus view, the key issue in the semi-liquid product is people not to use the liquidity feature. The very feature that have been prominently advertised as being the reason why it's now okay for private wealth, individual investors to actually come into these vehicles. I find that a little bit ironic. Joseph.
Just want to go back to a couple of basics of why we are seeing those trends, and also why firms like yours, Jean, have been growing very fast over the past decades, and ours as well in private market.
He does our publicity.
I just want to pick up one category. I'm sure you can talk about private equity as well. I'll pick up private credit. If you look at how lending works in the US these days, who lend money to mid-cap, especially mid-cap companies, let's focus there. 2/3 of it come from private credit fund, 1/3 come from banks. And banks have been put under pressure because of Basel II and then now Basel III. If you look at Europe, it's still very much intermediated by banks, although that percentage has gone down. It's probably the reverse. It's probably 3/4 in the hand of banks, 1/4 to 1/3 in the hand of private credit shops. What does it say? It says that the trend in Europe will follow what happened in the US, and the need to basically deploy more money to support the growth of companies. And there are tons of mid-cap companies out there in any sector that needs that lending capabilities, basically, that players like us can provide, is here to stay. So the fundamental reason why we see the need, the demand is there, and it's up to us also to provide the supply to balance it. Two, if you look at the split between public markets and private markets, we are not yet at half-half. But the demand for private market is big, and us as retail clients, individual clients, would love to benefit from both worlds. Why should I invest my money only in equity, fixed income, or multi-assets, only listed assets? I'd love to benefit from what Astorg, Aberdeen, M&G, whoever can produce great products as an investor, as long as I understand the liquidity terms. I agree. If I am a long-term investor for a portion of my portfolio, I'd like to benefit from that expected return. So I'd like the whole universe to be available to individual customers, not just part of that universe. Now, I agree, we need to be careful how we want to do it. And again, a number of us have been in the industry for too long. That's where sometimes some players or the industry wants to be greedy. We should not be greedy and make sure that we have the right regulatory framework to make it work. That's what the European Commission has launched, the LTIF. And this is why we have the LTAF in the UK as well. It's a way to define the right scheme for the right clients, not necessarily providing them with the most sophisticated products, but with liquidity terms. And that's what we did in our case. We launched a best of private credit to our clients, mixing more liquid private credit stuff like leverage loans with direct lending, much less liquid, to provide the liquidity terms that the clients are looking for and a better return than what normally a fixed income portfolio can do, but probably not as tilted as a long-term institutional clients who has all the time in terms of liquidity would get ultimately. So it's that mix that you want to start with, and be careful always of educating your clients. We put a number of educational models for our private bankers, the one to whom we distribute, the IEFAs, all the distribution partners we have at M&G. We put 9 different models at stake. We translated them in various languages to educate the intermediaries, the ones who will sell those strategies to the end customers.
Maybe just to complement and to address the second part of your question, because I think it's a great transition with what Joseph mentioned about the actors in that space. I mean, let's face it, most of the asset managers are interested in this space because it's a promising one that has a long to grow. But if you take traditional alternative players, it's not necessarily an easy step, not a natural one, because you are moving from managing money that is closed, that is evolving in series, that can range from 6 to 12 years of investment where you don't have to look at liquidity. And on top of that, it's usually an evergreen goes through a form of public, or even if it's restricted to high net worth individual, but a form of larger distribution to a retail audience, which is not something, again, that a traditional alternative investor is necessarily used to. At the opposite, traditional asset managers have the problem of being used to invest in public market and need to stretch to an area that is a bit different. So that's why you do have a few specialized firms like M&G or Aberdeen that have a kind of value proposal in between. And in Aberdeen case, we have been quite fortunate actually to have the experience of open-ended real estate vehicle that we didn't have to close. We have been managing actually an evergreen fund on private market for the last 8 years. So we have seen actually a few period of tensions in terms of liquidity, and that has give us comfort about the selective vehicle that we got to launch in that space.
I'll venture a personal comment, and then we'll move on to the next. Personally, I think also the primism with which we look at liquidity issues is a bit skewed by the fact that it's been a mantra for the mutual fund industry for like 75 years of daily liquidity. But you combine that with the Finance 101, which says that if you are in the public markets, you should be in it for the medium to long term. Why is daily liquidity so important? And I think it has skewed our perspective on liquidity. Now, I'll park that. You mentioned, we are under the auspices of the Economic Conference of the Americas. It started in Montreal and then expanded in the Americas and in Paris now for 5-6 years. I cannot leave this panel without talking about what's happening on sustainability or ESG. You are largely pan-European asset managers, but you presumably, and you didn't mention it, neither of you, significant money, or at least in absolute terms, capital from the US, where the discourse on sustainability or on ESG has evolved. Do you think that discourse is coming to Europe anytime soon? Typically, that's how it works. Innovation or changes in the US come to Europe. Sustainability has done a little bit different, but we now have a very different dichotomy. And what are you doing about it? Are you speaking differently from two sides of your mouth? You're changing vocabulary? You're not talking about it anymore? What are you doing?
Happy to start on this one. We do talk extensively about it. If I look at our strategies, we have plenty of Article 8 or Article 9 strategies under the European regulatory framework called SFDR, or their equivalent in the UK, but also Article 6, less sustainable strategies for clients who want it. If I were to look back of examples of the success of M&G this year, based on publicly available information, massive flows came up from impact investing wins we've had in Netherlands, massive pension funds allocating money to some of our successful strategies, but also Taiwanese pension funds who want to invest into sustainable or impact investing strategies. So my point, Jean, is the topic is still here in the mind of institutional clients in Europe, but also to some extent in Asia. When you go to Asia, and I know you travel a lot to Asia, if you go to China or those parts of the world, they feel the problem on environment every day. They feel it, they smell it, they breathe the air that is not the right one. So they know they have to invest into the area, and they do it at scale again. So that's a dialogue we're having with them, and the topic of sustainability is high on the agenda of institutional clients. When it comes, I will park the US for a second. When it comes to wholesale retail clients, we've seen a lot of effectively marketings 5 years ago on Article 8, Article 9. The whole industry went into it. The big consulting firms were saying there are much more flows in Article 8 and 9 than 6, meaning outflows in non-sustainable products, massive flows in sustainable products. It just happened, it was at the time of the COVID, where the most sustainable industries were the ones who were winning. Nobody was traveling, nobody was consuming oil on Earth for a few months, as you know, and therefore there was a misunderstanding of why those flows went into it. What happened? The whole industry went into it. Everybody kept launching those Article 8 and 9 with massive deception 12 months, 24 months after, saying, oh my God, these are not the flows we expected. But it was a misunderstanding of what happened. Just to conclude, I do believe there is a demand out there, slower demand for retail customers. It will take time, and we need to look at it from a long-term trend perspective and not be too much influenced by what's going on in the US.
Maybe before I let Xavier, or at least I'll ask a pointed question to Xavier. Yes, there's been a lot of massive flows, and Article 8, Article 9. I wouldn't say a nerd mentality, but still a very important underlying phenomenon. I'll turn it around. Is defense now part of ESG? Is defense now an investable category? We've been hearing about this for a few years now, given what's happening geopolitically. Are you there yet? And are your clients there yet?
I'm going to address your question. Just before, I want to make a comment, because I think Joseph raised a very good point. I was fortunate to have spent a number of years of my life in Asia. And I remember more than 10 years ago that when I look at when ESG was starting, in particular sustainability as an investment theme was starting to take off, I was struck by the fact that you had more clean or sustainable companies dealing with climate solutions in China than actually in the US. So I completely concur with your comment. Regarding defense, actually, I don't necessarily agree with your questions, because defense has never been out of ESG in itself.
Perception has been that it's out.
Perception has been that, but in reality, we were assessing defense as a sector and as a company in the same way we assess other companies in terms. And it's true that some part of defense, if you use the criteria of doing harm, were not necessarily ESG eligible in the past. But like a lot of company, ESG transition has also happened to defense company. I think what is happening now is the perception, and the perception has actually rated defense as an investable theme higher than what it was probably 5-10 years ago.
We're about to close. I'm told that it's possible, if someone wants to ask a question, to bring you in the debate. Is there anybody who would like to participate in this debate with a question to either of our panelists or both? I don't see hands being raised. Oh, excellent. Oh, no, I think he was just, just saying hi. Oh, yeah, good. Good. Thank you.
So, I just want to speak in French.
Oh, yeah, okay.
Because my French is the Franglish.
Ça va.
La problématique globale aujourd'hui du monde, c'est la problématique de l'arrivée et la solution elle-même de l'arrivée de l'IA dans nos vies. Les entreprises utilisent aujourd'hui à bon escient l'IA, mais on ne sait pas demain quelle serait tout à fait la tournure de l'IA. Comment nous pouvons faire pour que maintenant nous trouvions des solutions pour être imparables pour la sécurité du monde, pour l'IA? Parce que l'inquiétude globale, elle est suspendue dans la tête de tout le monde. Qu'est-ce qu'on va devenir demain si, par malheur, l'IA se passe autrement? La deuxième question que je voulais dire, parce que les gens pensent souvent que l'IA, c'est la magie. Non, c'est un entraînement d'une machine. Et les gens qui font cet entraînement de la machine, la plupart du temps, sont résidents dans les pays en voie de développement. C'est-à-dire, ces personnes qui entraînent les machines sont payées à un prix dérisoire. Qu'est-ce que les entreprises comme les vôtres peuvent faire aujourd'hui pour que ces personnes qui sont dans le sud global puissent être payées à bon escient et qu'on forme les universités à être plus denses dans le travail que nous faisons pour la maîtrise de l'IA? Je vous remercie.
Just for those who might not be francophone, 2 questions that really go beyond asset management. They're really about the world at large. How do we make sure that AI use is to good bon escient for a good purpose? And secondly, how do we rebalance the economic contribution of people in certain areas who are very gifted, but in writing code and developing these tools, but which are not compensated like they would be compensated in other parts of the region? Those really are way beyond this panel, but I want wondering, Xavier or Joseph, if you want to add something. Perhaps answering in French, given the answer was in French.
Oui.
I translated it for the benefit
Absolument.
of...
Ben, je pense que vos 2 questions sont très pertinentes. La première, elle pose la question de l'IA et de l'éthique de l'utilisation de l'IA. Moi, ce que je peux vous dire, c'est nous, en tant qu'entreprise, et je pense que d'autres entreprises le font dans notre secteur, j'espère dans d'autres secteurs également, c'est avant de mettre en place l'IA, par exemple, chez MNJ, on a pris beaucoup de temps, au point où toute les jeunes salariés d'entreprise commencent à s'impatienter en disant « Mais qu'est-ce que vous faites ? On veut l'IA, on veut l'IA, on veut l'IA. » Ce qui s'est passé, c'est qu'on a pris beaucoup de temps à se poser ces questions que vous avez posées, en se disant comment, d'un point de vue éthique, on veut utiliser l'IA, quels sont les bons comportements qu'on veut voir, et quels sont les mauvais comportements, pour pouvoir mieux le réguler au sein de l'entreprise. Parce qu'une fois que vous ouvrez les portes de l'IA, si vous ne contrôlez pas ce qui se passe, vous ne contrôlez rien du tout, ni d'un point de vue comportement, ni d'un point de vue éthique, ni d'un point de vue effectivement résultat éventuellement, et la qualité de ce que vous avez. Donc on a mis en place des process, et j'espère que toutes les entreprises le font, pour effectivement avoir ces garde-fous qui sont très importants pour que l'IA soit utilisée à bon escient, qui est votre question. Sur la deuxième, pour moi, ce qu'il faut, c'est que notre secteur, alors il se trouve qu'on le fait nous, mais je pense d'autres le font également, investissent dans le Global Sud. Alors, on a une filiale qui s'appelle Responsibility, qu'on a achetée il y a 5 ans, qui fait de l'investissement à impact uniquement dans les pays émergents, qui investit en Afrique, qui investit en Amérique latine et qui investit également en Asie, dans des domaines comme financial inclusion ou la microfinance, le food ou éventuellement le climat. Donc voilà ce qu'on arrive à faire. Et je pense que c'est en déployant ces investissements qu'on va pouvoir répondre à vos questions.
Xavier, any final word? Un mot de la fin parce qu'il faut terminer.
Non, en fait, je rejoins complètement Joseph par rapport à cela. L'IA, c'est un outil. On peut utiliser un outil à bon escient ou à mauvais escient. Et c'est quelque chose qui est extrêmement important. Aujourd'hui, c'est un outil qui hallucine aussi. Donc, dans l'utilisation de l'IA, notamment par rapport à nos clients, quand on utilise certaines fonctions qu'on a développées en interne, on le fait sur des bases de données propriétaires pour justement éviter ce problème d'hallucination. Mais fondamentalement, il y a des questions éthiques que Joseph a soulevées qui sont tout à fait pertinentes. Et pour votre deuxième question, Aberdeen, on a une tradition d'investissement dans les pays émergents. On a à peu près 20% de nos revenus qui viennent de pays émergents, contre en moyenne 3% pour un asset manager traditionnel. On espère qu'en continuant d'investir dans les actions, dans les obligations des pays, y compris dans les frontier markets, on contribue fondamentalement à élever les niveaux de vie locaux et résoudre un problème au-delà de l'IA.
Sur ce, thank you very much. Merci à tous.